Hello and welcome to the lecture for Chapter 2. In this chapter, I'll go over the professional standards that guide how audits are done, specifically the AICPA and the PCAOB standards. Those together form the principles of generally accepted auditing standards, or GAS. A copy of the AICPA standards, a link to that is, you can find that on Moodle in the general section at the top of the course. I'll talk about the auditor's responsibility to detect error, frauds, and non-compliance with laws and regulations. I'll cover some of the key elements of audits reports, and I'll talk about other types of reports issued by auditors, different types of opinions. Talk about the nature of attestation standards, quality control, and I will not cover international audit standards, although it's in your book, meaning I won't test you on it either. So the profession really started in 1939. There was a large financial scam in 1938 that involved hair tonic that had alcohol in it, and that was during Prohibition. Investors invested in this, what was then considered a pharmaceutical company, and ended up losing all of their investments due to illegitimate financial reporting. That was a $20 million loss. In today's dollars, that's $365 million. And so the profession, the AICPA, chose to self-regulate. Often industries will choose to self-regulate to kind of preempt the government from regulating them. So that's kind of how that played out. So they developed rules about how audits should be done. In 2002, based on failures of audits in companies like Enron and WorldCom, the Congress got involved and passed the Sarbanes-Oxley Act. It was specifically directed at publicly traded companies, so companies where you could buy and sell shares of their stock on the stock exchange. Part of that law, and it's a fairly large law, part of it created the PCAOB, the Public Company Accounting Oversight Board. That's an entity within the federal government that oversees the accounting profession, the accounting firms that audit publicly traded companies. So it doesn't cover all audits because many audits are done for non-publicly traded companies as well. So both groups issue pronouncements about how audits are to be done. Collectively, they're referred to as generally accepted auditing standards. So again, the PCAOB, that deals with companies that are registered with the Security and Exchange Commission. They're referred to as issuers because they can issue shares of stock to non-sophisticated investors. And the AICPA issues statements on auditing standards that cover audits of non-public companies. So the standards that I provided you a link for, which are free, is the AICPA standards. There is then also an International Auditing and Assurance Standard Board that deals with auditing standards for foreign entities. So the components of generally accepted auditing standards are based, like accounting standards, on fundamental principles. So and I'll cover those shortly here. So those fundamental principles then lead to both PCAOB auditing standards and the auditing standard produced by the AICPA. Those are then further refined by interpretive publications. So specific directions about new classes of assets, for example, I'm sure there are publications about the audit of cryptocurrencies, things like that, that have emerged that require more kind of fine-tuned direction. They would also have industry-specific. So how do you measure value of inventory or audit inventory for a chemical company or gas and petroleum type company, those sorts of things. So they'll issue publications to help auditors do a better job in those kind of circumstances. So it's important to keep in mind what the objective of an audit is. So the objective of an audit is to obtain reasonable assurance about whether the financial statements as a whole are free of material misstatement, whether due to fraud or error. So there's a couple words there that are key. Reasonable means not absolute. So an auditor isn't going to give absolute assurance that everything is done correctly. because it would be cost prohibitive and time prohibitive to audit every single transaction that a company engaged in. So there are judgments involved, there is sampling, and they based an opinion based on what they find from that sample. So it's a reasonable assurance versus absolute. I'll talk more about the word material shortly, so I won't go into defining it here. And then their objective is to issue a report on the financial statement. So a document on the auditing firm's letterhead that gives an opinion about the financial statements that are attached to it. So the auditor's responsibility for detecting misstatements. So there are two different kinds of misstatements that could either occur through error or through fraud. One is errors that have an impact on the financial results of the company. So it is the auditor's responsibility to identify, or to a reasonable level of assurance, non-compliance with those kinds of laws and regulations, because they directly impact the figures on the financial statements. An example would be a company that you are auditing and you find out through talking to people in the factory when you're taking inventory that the company has a policy of not paying time and a half for overtime, which is required by federal law. Well, that means that the company is violating a law, okay, and that violation of a law has a direct bearing on the financial statements, and that they've understated their wage expense, potentially understated inventory expense, potentially understated cost of goods sold, and inflated net income. So that would be an example of a non-compliance with a law that had a direct material effect on financial statements. In terms of other kinds of laws, let's say you're at the same facility and you find out that they are violating an environmental law, or maybe a safety law within their factory. Their workers don't have hearing protection or eye protection that's required by OSHA, that sort of a thing. If they come across something like that, they should inquire of management about it. And if we become aware of this, maybe you weren't aware of this law, blah, 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 that sort of a thing. They could inspect any correspondence. If management says we've been given approval to do this or that, well, let us take a look at it, that sort of thing. And then if the information comes to the auditor's attention, they could then apply some audit techniques to determine whether or not non-compliance has occurred. If that's the case, their responsibility is to inform the appropriate level of management, meaning one level above the infraction. It is not their responsibility to identify all circumstances in which non-financial laws and regulations or violations of laws and regulations that don't have a direct effect on the financial statements. It's not their responsibility to find all of those. Now, an overview of what the fundamental principles are that I talked about earlier. So one category deals with the responsibility of the auditor. So competence, capability, ethics, and professional skepticism. And I'll talk about each of these in more detail. The next is a performance principle. So how do they actually carry out the audit? Okay. And then reporting principle. What are the guidelines that govern issuing an opinion letter? So responsibilities include making sure that you're competent and capable of performing the audit. So that means an auditing firm shouldn't just accept all jobs that come their way. Say we have a small auditing firm here in Olympia and we primarily audit not-for-profits. If a large for-profit technology company came and asked us to do their audit and promised to pay a huge fee, if we didn't have the expertise in our company to evaluate the kinds of issues that would be at play in that audit, then we should turn that audit down. So we should only take jobs that we're capable of doing, or we should get competence, meaning hire people that know that to work within our company. We'll talk more about independence in the next chapter, but the key thing to think about here is independence in fact versus independence in appearance. So independence in fact means, can you legitimately make an independent judgment about the financials of a company without being swayed by your relationships with that company? So are you able to be objective? Okay. Independence in appearance is, you might be independent in your own mind, but how does it look to other people, to other stakeholders like investors or creditors? If you have an overly close relationship with the management of the company, maybe you own vacation property together, or you spend lots of time together and it's all over your social media or something, it could appear that you might be lacking in independence, which would erode the credibility of the assurance that you offer for their financial statements. We'll talk in Chapter 3 also about financial and managerial relationships that are not allowed in order to have independence. And then due care. If you do an audit and you miss something and it causes somebody for financial harm, you could be sued as an auditor. And what level of competence or what level of activity would you be held against? What would be the standard there? And the standard is due care. So what would a reasonable auditor in similar circumstances do? So it's not an expectation of being perfect, but did you miss something that, yeah, most people would have also missed, that kind of a thing. In addition to that, we talked in Chapter 1 about professional skepticism. So that's basically not taking management at its word for anything, but being diplomatic about that, looking to third-party evidence, looking for evidence that either contradicts or confirms other evidence, that sort of thing. And then applying judgment. So what have you seen in past audits? What do you know about accounting from your education and your experience to make informed decisions? Again, I mentioned earlier, the goal is to provide a reasonable, not absolute assurance that the financial statements are correct. So in order to do that, you need to, of course, plan and supervise the audit. You need to decide which staff members at your auditing firm are going to be involved in the audit, what each person is going to do, what their capabilities are, when are they going to do that work, because some things have to be done before other things, and so forth, and then supervising them, making sure that that staff are doing the things in the way that they're supposed to. So materiality is something we'll also talk about in a later chapter in more detail, but the level of materiality is defined as the level at which, if the mistake was not known, it would influence the decision of an investor or a lender. So does it rise to that level? So if it's a $5,000 mistake in the audited financial statements of Apple, that probably wouldn't influence somebody's decision given the scale of the company. If it's a $5,000 error in a very small company, that may be material. So it depends on the nature of the category and the size of the company. Risk assessment, that's something that primarily deals with internal control. So understanding the entity, if you go into the entity and they have a very good system of internal control, so they have good policies and procedures in place, and those policies and procedures are being followed, then that reduces that type of risk in the company, and you can do less work in terms of the sample size you would select and so forth. So if they have very little internal control, or if they've never heard the words internal control, then you would of course need to increase the types of tests that you need to do in the field. So audit evidence, two different issues there. What is the level or quantity of evidence that you need to be considered sufficient? Again, that relates directly to the risk of the entity. The risk of their internal control, and then the appropriateness of the audit evidence. That is the quality of it. So how reliable is it? Third-party documents are more reliable than documents prepared by management. Originals are more reliable than copies, all of those kinds of things. So expressing an opinion, it's going to be, or that an opinion can't be expressed, it's going to be done relative to a financial reporting framework. So in the US, that would be GAAP, or it could be IFRS in an international company. So we'll go over this in more detail later in the semester, but I wanted to give you an example of an opinion. This one is for McDonald's. So first of all, this is a publicly traded company, so it's guided by the rules of the PCAOB. And I'm not going to read it out loud to you because you can read as well. But the first thing to notice is who it's directed to. So it's directed to not the management of McDonald's, not the CFO or the CEO. It's directed to the board of directors and the shareholders of the company. That's who the audit opinion letter is directed to. The first paragraph of the opinion letter, and they all follow the same format, describes who is responsible for what. So what are we looking at? We're looking at the financial statements of this company for these periods of time, and then a clear statement that the financial statements are the responsibility of the management. Our responsibility is to express an opinion. The second paragraph says, what did we do? So it describes that we did an audit in accordance, in this case, with the PCAOB standards. So what is involved in that? Assessing accounting principles, looking at estimates made by management, evaluating overall financial statement presentation, and here we express our opinion. We believe that our audits provide a reasonable, this is not the opinion, this is just that what we've done is a reasonable basis for the opinion. Sorry about that. The next is the opinion. So here it says clearly, in our opinion, the financial statements referred to above present fairly in all material respects the consolidated financial position of McDonald's Corporation on the following dates, and that it's in conformity with US GAAP. So that's the opinion portion of that. The next paragraph is required for integrated audits of publicly traded companies, which means you also need to audit management's report on the internal control of the company, the internal controls that are in place. So we're expressing opinion on both of those things. So there are different types of audit opinions. The one I just showed you is either called unmodified or unqualified, meaning you're saying it wholeheartedly. There are no except for this or except for that. It's also called a clean opinion in kind of common terms. The second type is a qualified opinion. So that's everything is good except for blank. And that may be due to timing. So it could be everything is okay in this audit except for inventory because we were engaged after inventory had been taken. That could be one thing. It also could be everything is okay except for the fact that management doesn't feel that they need allowance for doubtful accounts and we feel that they do. So a difference of opinion with management about a particular issue. And then a reader of the financial statements could evaluate how important or unimportant they think that aspect is. You could issue an adverse opinion, which says these financial statements are not in accordance with GAAP. That's, of course, very bad. Or a disclaimer that we cannot express an opinion, either because we've been limited to what we can access or whatever the case is. So the system of internal quality control exists at a couple different levels. So at one level, there is quality control within a firm. So staff people will do work and the senior person on the job will review their work. The manager will review the work that the senior has compiled and the partner will review work of the manager. So each level is looking at the work of the level before, raising questions, asking things to be redone, and that sort of thing. Oftentimes, an uninvolved partner in the firm will periodically look over the work of other partners to make sure that the partnership isn't being put at risk unnecessarily. They'll judge relevant ethical requirements. Are all the people engaged in the audit independent in fact and in appearance? They'll use that information to decide if they should accept or continue client relationships or specific engagements. So human resources are a key thing. How qualified are the people that we hire? Are they all, have they all passed the CPA exam and been licensed? Those kinds of things. There's also a system of monitoring, so both the internal kind of monitoring I just mentioned, and then for firms that do non-public audits, so AICPA governed audits, there's a system of peer reviews. So for example, in Washington State, firms will periodically ask other firms to come in and look at the quality of their work papers and their procedures and give them feedback on what could be done better. When it comes to publicly traded firms, PCAOB governed firms, that's done through inspection. So the federal government, the PCAOB, will come in and do an audit of the auditor, looking at their working papers, making sure that they've done things properly. If the firm is large enough where it audits more than 100 public entities, then the PCAOB will come in annually and again make a sampling of audits and look at everything that was done in those audits to say, can this auditing firm continue to be registered to do audits of publicly traded companies? That's what's at risk if they don't do a good job. If they audit less than 100 public entities, then the PCAOB will come in every 3 years. So that inspection looks for deficiencies in audits, and again, if they rise to a significant level, then they could lose the ability to do audits in the future. So thank you for your time. I look forward to talking to you during the lecture for Chapter 3. Thank you.